Copper dropped to its lowest in almost a month today before recovering with help from a stronger euro. Joining me from London for a look at the commodity space is Daniel Smith, Head of Metals Research at Standard Chartered. Daniel, we saw the copper price there today going to that low point, but we expect it to be trading between that 7,200 and 7,800 level. Is that what you're expecting, or where do you see copper go?
Yeah, I think in the next couple of days we could well see copper drift lower. So we broke down below some of the important support levels just a few days ago, and of course with a lot of the focus at the moment on Europe and the weakening PMIs that we saw out of there this week, I think there is probably a bit more downside, but as we said, we are pretty bullish on copper from a medium-term perspective, so I think any weakness will prove to be relatively short-lived.
Now, Daniel, we did see the gold price there increasing for the last 2 days, but the general trend for the last couple of months has been a downtrend. Where do you see the gold price heading from here? Are you a bit more bullish about that, stepping to a safe haven, or are you just, in the same sense, a bit more skeptic about that price going up?
Yeah, I mean, I think what was interesting is in the past week and past month, what we've seen is a kind of fairly clear differentiation across the metal space. So those kind of safe havens have done actually relatively well. So gold held up very well through this period of dollar strength that we saw in the past week or two, and then it has rebounded, of course, today as the dollar started to weaken once more. So, and that was seen across the precious metals space actually. So if you look at it as a kind of spectrum from safe haven to industrial precious metals, so gold has done the best, then silver, then platinum, then palladium. Of course, that fits in very neatly with those markets which are most tied to the industrial cycle and those markets which are most tied to the kind of safe haven side of things. So I think it's interesting to note that across the board, and I think what we will see actually is if the dollar does start to turn and we see more dollar weakness, then you can see markets like gold and silver doing very well. And we are bullish on platinum as well. Of course, we saw some announcements of cutbacks by Amplats in the last few days on the back of following on from other producer cutbacks that we saw a week or two ago. So producers are starting to cut in platinum as well, and we think it can benefit from this kind of safe haven story as well. So we see very limited downside for platinum, and it does have the potential to come back quite well if we see any kind of turnaround in the underlying economic story.
Daniel, just staying there with gold and platinum for a second, we have actually seen the difference between gold and platinum price widening to an extent. What do you ascribe that to?
Well, I think what we're seeing is actually it's a good question. I mean, what happened is platinum has been very depressed really because of underlying weakness in the market. But the main talking point for me is actually, I think it's clear that there is a decent amount of platinum out there. The main question really is has that been driven by an underlying problem in the supply and demand balance, or has it been driven by investor flows? So my take on it really is that people have slightly misinterpreted that excess stock. I think a lot of it is coming from investor selling, and potentially they can pick that metal back up again once things start to turn around. So platinum has underperformed. In terms of, I think also the markets are starting to move a bit more towards expecting further QE from the Fed. So we have seen some significant weak data out of the US in the past couple of weeks. So of course employment data has been relatively poor. PMIs are disappointed, so all of those kind of things tend to help gold and tend to pull down platinum. So I think that's the main reason that gold's doing better at this point.
Like you mentioned there, the talks of the QE could be an increase there for the gold price. Let's just quickly turn to the oil price. We know that most of the companies like Exxon and the oil companies are to report earnings in the US, and we're expecting lower earnings to come there from them on the back of that lower oil price. What do you expect for the oil price from here with lower growth going forward?
Yeah, I mean, it's a good question. I mean, obviously not my area of expertise, but generally we are looking for a higher oil price in the second half of this year. So I think the key thing to focus on really is, we've been through this cycle, and if you look at, say, US and China, I think there's some good signals coming through there in terms of the construction markets, for example, and the auto market. So in both cases, I think things have bottomed. So that gives us some reassurance that actually the, maybe sentiment in these markets is going to pick up actually in the second half of this year. I mean, within that, I think China is particularly critical, certainly for the markets that I look at. So, I think what may well happen is as the government starts to ease monetary policy, cut rates and pump money into markets like infrastructure, what you may well see is that markets will actually turn up well ahead of the actual improvement in underlying activity. So, of course, markets are very forward-looking and they tend to focus on where we're likely to be in 6 months to 12 months' time rather than the actual underlying story. So, we may see further weakness in China in the next few months and possibly into year end, but the more important thing is what is the government doing in response to that. So as long as we see fairly aggressive stimulation from the Chinese government, I think there'll be pretty limited downside for a lot of these markets, and oil to some extent will benefit from that as well.
Thanks for your insights there, Daniel. That was Daniel Smith, Head of Metals Research at Standard Chartered.